Hi, I'm Garth McKenzie from traderscorner.co.za. As usual this week, I'm taking a look at the S&P 500, and I'm also going to take a look at the VIX index, the volatility index, to show some interesting divergence that is beginning to show up there. So if we start off with a look at the S&P 500 daily chart, that shows the extent of this market rally. I mean, it's been an incredible V-shaped recovery off the lows. Very, very few people would have expected such an aggressive bounce to the upside. There's a saying in the market that the bull climbs up the stairs and the bear goes down the elevator. Well, it seems like somebody showed the bull how to use the elevator, because this market rally has just been unbelievable. You can see on this daily chart here how the market broke out of that sideways channel in early May, and it's begun to push to the upside again after that brief period of consolidation. What's quite evident if we look at the chart on the right-hand side is how the steepness of the rising trend is beginning to accelerate here. There was a big gap up in the chart 2 days ago, and that one could possibly see as an exhaustion gap, but we'll have to see whether there's a reversal that follows. But with this speed of the rally that we're seeing at the moment, it's quite possible that this momentum does continue to the upside. There's a gap in the chart up at 3,330 from late February, and that was from just before the market crashed. And it looks as if that gap could in fact be targeted if the market does continue to head to the upside. And many are calling for possible new highs on the S&P 500. We've seen new highs on the NASDAQ already, which is the leading area of markets, tech, and what have you. The S&P 500 looks as if it's not far behind. Moving forward then to the hourly chart of the S&P 500, here you can see that sideways channel that was evident through early May. It broke to the upside when the market broke above 29.50. Since then, it's been in a rising channel, quite a neat, tidy rising channel. But again, look on the right-hand side of that chart and notice how the acceleration or the speed of this upward move has begun to accelerate. And you can see the gap on the right-hand side there that I alluded to on the daily chart as well. So strong upward momentum still very much evident here. But if we now move to the VIX, this is the volatility index on the Chicago Board Options Exchange. It's the measure of volatility, of implied volatility, that options traders use when pricing up options on the S&P 500. What's quite interesting to note here is that the VIX index has come back a long way from the peak of about 85 that it reached back in March when the market was at its worst in the crash. And the VIX index has moved lower since then. And what's evident now is that the VIX seems to be testing the 200-day moving average, and it has shown evidence of beginning to reverse up off the 200-day moving average. Certainly over the last 2 days, that is the case. And that's quite interesting to note, that the VIX is beginning to turn a little bit firmer when the S&P 500 index itself continues to move higher. And there's a little bit of divergence there. Usually a rising equity market is associated with a declining VIX typically. So this kind of divergence is interesting to note. For the final chart that I've got here is an hourly chart of the VIX index. And this also shows what I've been talking about. You can see that over the last 2 days, the VIX index has been pushing up. It's lifted up from a level of 24 up to nearly 26 last night. And from a technical perspective, one could argue there's a little bit of an inverted head and shoulders pattern there on the VIX chart itself. I'm always a little bit skeptical when it comes to these types of patterns on the VIX, but nevertheless, it's worth noting that it's there, and that 26 is a level of resistance for the VIX index. And if that were to break, that could possibly indicate a rise in volatility, which would also probably be then correspond with a pullback in the equity market itself. Finally, also note that there is positive divergence on that hourly chart of the VIX index. You can see that on both the stochastic oscillator at the bottom of the page there, and also on the relative strength index, which is at the top of the page. That positive divergence is telling you that the downward speed of this VIX move lower is beginning to slow, and often you get that type of positive divergence just before a change in trend. So it could be an early warning sign that VIX is about to pick up. In other words, volatility is about to pick up. And if volatility is about to pick up, that would then imply a pullback in the equity market, in the S&P 500 itself. So I think it's worthwhile just keeping a note of that divergence. Yes, the momentum is to the upside on the S&P 500 for now, but do keep in mind that the VIX is just giving us a little bit of a warning sign to be a bit cautious of being too aggressively long. That's all that I've got for you this week. I'll be back again next week with another look at the S&P 500 and some more market analysis.